if I was to ask you, Brendan, to just write a book about what private equity has done for America, and said you have to write a book about how private equity built America, what would be the topics? What would be the null argument to the pillage?
My critique of the legal and regulatory structure around private equity is basically three things. One, we already touched on, which is that private equity firms tend to be very good at insulating themselves from legal consequences when things go wrong at portfolio companies. Second thing is they tend to take a fairly short-term perspective on their investments. And then the third is that they tend to lever up the companies they buy with a lot of debt and extract a lot of fees. When those are pursued in their extreme, I think they lead to the worst outcomes for the portfolio companies and the people that work for them and buy from them.
Welcome to Analyzing Healthcare by Scale Community, which is an education-focused organization comprising of passionate global healthcare leaders. Analyzing Healthcare is Scale's podcast series dedicated exclusively to unpacking the myths and foibles that have been directed at US and global healthcare for as long as we can all remember. Is US healthcare broken? The worst in the world? Perhaps, perhaps not. Let's find out together as we invite thought leaders of healthcare to share their views. I'm your host, Roy Bejarano.
All right, we are on our way for our latest macro podcast. I'm honored to introduce Brendan Ballou. Am I pronouncing that corrected?
Ballou, but any version is fine.
Ballou. I love it. It's a great name. BB. I've only got one B. You've got two. So I'm going to start the way I normally start, which is how did you end up doing what you're doing? So it sounds like your focus has been the law, but also research, authorship, macro level topics, because I know you've written a very interesting book about private equity with a focus on the US, but maybe just private equity in general. And so it sounds like you're wearing two hats, but what led you to these at least two hats, if not more?
Well, I can start with the private equity one because that's probably simplest. So during quarantine, I was just reading the news on, this wave of acquisitions that was happening. It seemed like every business in the United States was getting bought up by somebody, and they were getting bought up by firms that I had never heard of, Blackstone, Carlyle, KKR, and so forth. And for anybody that follows private equity, those are familiar names, but if you don't, they were strange to me. And so I started researching those firms and then the private equity industry generally. And it seemed like it was having this transformative effect on the country. And so I just started digging into it. And that's what led to the research and ultimately what led to the book.
So the book is Plunder, Private Equity's Plan to Pillage America. That's a lot of P's, 4 P's.
Very alliterative, yes.
You're a fan of the P. So I have nothing but questions. And I approach the conversation somewhat as a devil's advocate, but with a lot of respect I looked at some of the conclusions and appreciatively the recommendations that you made, and start at the end. I think a lot of them make sense. So I'll start there. But I'm interested in the process, the methodology through which you reached your conclusions. So my first question to you is, how much research did you engage in regarding real hard factual research? Did you engage in regarding private equity? Because my background in private equity is quite extensive. I actually grew up in a private equity household. My father co-invested and led deals with 5 different European private equity funds over 40 years. And my business today has worked with well over 100 private equity funds. And we cover about 800 of them loosely, 300 of them actively. So I would say I know the mid-cap space well, a little bit of the large cap space, which I know you spent some time on, a Carlyle deal, a Blackstone deal, but there's hundreds of them and they do different things. So how well do you know the 800 private equity funds that are either tacitly or very purely focused on, let's say, US healthcare?
Yeah. So, my background was as a lawyer. So what I was trying to figure out were what were the legal and regulatory incentives around the industry. So I think a criticism of the book, and I think it's a perfectly fair one, is that I did not bring a particularly economic or quantitative approach to the project. I think that's a totally fair criticism, but I also think that's a different book, one for an economist to write, not a lawyer. So what I was trying to do with the research is focus on specific examples when there is quantitative research out there in terms of bankruptcy rates and job loss or, injuries or deaths and things like that. Point to those, but try to use those specific stories to illustrate how the legal system incentivizes some short-term thinking. So, you mentioned the Carlisle example, which is what starts off the book, which is where Carlisle bought up a nursing home and ultimately slash staffing, and then a person died in an allegedly understaffed nursing facility. And, that's one story, but what it illustrates is what happened when the family tried to sue for wrongful death, which is that they weren't able to sue Carlisle, or they weren't able to survive a motion to dismiss because they weren't able to pierce the corporate veil. Carlisle described itself as a mere advisor to a series of funds whose limited partners ultimately owned the nursing home. And so what I think that example illustrates is how our legal system can often allow private equity firms to capture the financial upside of acquisitions when they go well, but experience very little legal or financial repercussions when they don't.
So let's focus on the Carlisle example. I know there's reference to a Blackstone case study in hotels, Apollo in entertainment, KKR. These are, and Cerberus, these are the most well-known private equity firm names out there. In some cases, one would argue not necessarily private equity. Cerberus is invested in public securities, invested in a lot of debt securities, which is not the same as private, not the same as equity. They do some private equity and they're very large. So their definition of some is greater than most, but on a weightings basis, I don't think of Cerberus predominantly as private equity. Having said that, Carlisle wrote the book on private equity. And Steve Schwartzman at Blackstone, and at Apollo, you got the notorious Leon Black, Sun Capital, and what they've done in retail. These are stalwart names, but it's worth noting that there are 5 names amongst 1,000. And so let's focus on Carlisle in Manicare, but let me also start with a very macro question. If I was to ask you, Brendan, to just write a book about what private equity has done for America, not the pillaging, but the opposite of pillaging. If I forced you, almost wrestled you and said, you have to write a book about how private equity built America, what do you think would be the chapters? What would be the topics? What would be the null argument to the pillage?
Yeah. Well, and I tried to include some examples of where I think private equity firms have been successful. I think at the beginning of the book, we talked about Gray Wolf Capital investing in restarting a timber mill in rural Arkansas. And it was, by all accounts, very successful in large part because the firm, invested equity. They did not actually engage in a leveraged buyout as it was reported. And they took a pretty long-term perspective, sort of as I recall, about a 10-year investment. And then even after they substantially exited, they continued to have board representation on it. So, to take a little bit of a step back, because I want to be responsive to your question, my critique of the legal and regulatory structure around private equity is basically 3 things. One, we already touched on, which is that private equity firms tend to be very good at insulating themselves from legal consequences when things go wrong at portfolio companies. Second thing is they tend to take a fairly short-term perspective on their investments. And then the third is that they tend to lever up the companies they buy with a lot of debt and extract a lot of fees. When those are pursued in their extreme, I think they lead to the worst outcomes for the portfolio companies and the people that work for them and buy from them. When those are dialed down, I think, private investment can be a perfectly fine and helpful part of our economy and our financial system. So the longer term perspective a firm takes, the more responsibility it takes for its actions and the less reliant it is on levering up the companies and extracting a lot of fees, I think the more successful the private equity firms can be for themselves and for their businesses in the long term.
Here's the challenge. I agree with you. The challenge is that that's not the title of the book. I don't know how many journalists read the book. I don't know how many politicians read the book. But I do know that across the country, up until very recently, there was regulation being proposed to ban private equity statewide. California being a perfect example. AB 3129, I think, is the number. Don't hold me to that number. But it was definitely AB. And it was passed. It was only vetoed by the governor, Governor Newsom. God bless his soul. I spoke with parties that were for and against the regulation and spent some time with the lobbying groups on both sides. I've read a lot of the materials that have been passed, the MedPAC study that was performed on behalf of Congress, JAMA materials on private equity, where they interviewed 850 doctors for their feedback on what it's like to work in a private equity-backed group, and it was resoundingly negative. Only one problem: of the 850 doctors, only 30 doctors had actually worked in a private equity group. The rest were just sharing opinion. Secondhand opinion. This was buried in the disclaimers. And this is a long-winded way of saying that I actually agree with your directional conclusions. The problem is the research is misleading collectively or thin, not very well built out. The MedPAC report was 4 transactions: nursing home again, hospital, whether it's Steward Health or another hospital case study, Envision, Team Health, emergency room staffing, the Blackstone case study. So you're talking about 4 or 5 case studies amongst thousands and thousands of transactions just in my industry alone. Right, to give you some context, there's about 1,500 private equity-backed healthcare services organizations, private equity-backed, that represent about 15% of the US physician population, 150,000 doctors, about 26% of all the practices across the country. And each of them acquire a practice 2, 3, or 4 every year. That's how many transactions we're talking about, life-changing transactions. Physicians move from being hospital-based to being carved out, from independently owned to being corporate-owned to being corporate-backed. There's just thousands and thousands of these examples. There are a few studies that have come out recently that focus on the industry as a whole, the entire movement, and they study things like trends in reimbursement. Does private equity raise prices, lower prices? From a revenue standpoint, from a population and patient pricing standpoint, from a payer standpoint. And those studies are more scientific, I would say. And I think when you create an ocean that's large enough, you can agree with me, there's going to be examples of everything. But the real question is, what is the trend? Not what are the anomalies. If I pointed to 5 great private equity deals, wrote a book about it, and said, that's it, my argument is done, they're awesome, that wouldn't be fair. That wouldn't be scientific. And so I think directionally, you're right. My experience of private equity has been mixed. Some deals are over-levered. In some cases, there's a shortage of equity. What to do about that? But I think it's worthwhile highlighting for our audience that this is a very big subject, and there's a lot of data in it before we reach industry-wide conclusions.
No, totally. And, one of the challenges that I think we have in sort of the discussion around private equity is you sort of have the battle of the anecdotes, which I think tends to lead to sort of just a mushy middle. The thing that overarchingly concerns me is less specific anecdotes and the overall incentives that we've got around the industry. One that particularly concerns me, and, I think you would appreciate this given your familiarity with the industry, is the fee structure system, which is, private equity firms tend to be compensated on a 2 and 20 model. I assume your listeners are familiar with this, but just to set the baseline, the idea being that they get 2% of the assets under management every year, and then 20% of the profits of their portfolio companies once they meet a certain benchmark. So they get 20% of the profits with, some details on the edges. But then they also, as captured in the limited partnership agreement, are entitled to various fees. So you get a management fee every quarter or every year for managing and owning or operating the portfolio companies, and then transaction fees when the portfolio company does a specific deal or sells off certain assets and things like that. The incentive challenge that we've got is that the private equity firm only gets 20% of the profits, but it gets 100% of the fees. And so oftentimes, I think private equity firms are incentivized to engage in things like sale leasebacks, where, again, I know you're familiar with this, but just to set the baseline for your audience, they sell the underlying real estate of the portfolio company and then lease it back to itself. They may be incentivized to engage in a sale leaseback, even if that might harm the long-term profitability of the business because they will get 100% of the transaction fees. And so I agree. I think we can get into a battle of the anecdotes, but the way that
they're going to get more than the transaction fees. If there's a dividend associated with the leaseback, they'll get a portion of that too on an IRR calculated basis. So it's even richer than that. But transaction fees, 100%, sure.
Yeah, exactly. So, I think the challenge that we've got is the way that these deals are often structured, they're incentivized to engage in some short-term thinking. And so I think it's helpful to talk about what are the overarching incentives of the industry, because those are the things that we want to get right.
Let's talk about that incentive. And let's talk about the null hypothesis to doing the wrong thing. All right. So what's doing the wrong thing? Focusing on fees to the detriment of an asset, a business, and all its otherwise benevolent intentions. And I mean that sincerely. Most businesses that I come across, and I've one way or another interacted personally with thousands over the 30 plus years that I've either been a banker or an entrepreneur or a consultant, a large number of businesses. So there is some empirical context to this, plus all the research that I do on the side. Most businesses that I come across are interested in doing the right thing. Otherwise, they fear that they'll go out of business. And frankly, a lot of them, not all of them, but a lot of them just want to be good people. They sleep better at night being good people. It's a hard sleep when you're trying to do horrible things and get away with them. It's a harder sleep. So people value their rest. So what is the null argument for private equity interrupting that journey with let's do the wrong thing? Let's laden a steward health with way too much debt, strip the assets, sell them off piecemeal, destroy the equity value, take money out. Let's fire a lot of people. Let's understaff. Let's underpay. Let's piss people off. Short-term thinking to an extreme, but let's maximize our short-term return and let's sacrifice the long-term outcome for the collective whole. What's the null hypothesis for that? So let me offer you a few. And I think I'm on the winning side here. I'll tell you why. Empirically, if for every 10,000 companies that private equity has owned majority stake in, something like 9,000 have done well, have moved on. Another way of saying that is 90%. 90% of the average private equity portfolio does well. This is what's interesting about venture capital versus private equity. Venture capital has a much better reputation than private equity in the world. And by the way, I'm blending private equity with vulture investing, which is unfair to private equity. Cerberus is a vulture investor, right? If you're really strict about the terminology, margin of safety investing, liquidity-based investing, distressed investing, asset-based investing, loan-to-own investing, these are all vulture tactics. Drexel Burnham started it, Junk Bond Kings in the 80s and Michael Milken started it, and the Drexel tricklation down into all the different large assets that have emerged since then, like Apollo, is well documented. This is a school of thought. But the vast majority, the 800 or so sponsors, private equity groups that I know, they don't do sale-leasebacks. Very few of them do sale-leasebacks. They borrow a lot of money in order to buy an asset because it's highly competitive. And we can talk about that because that is a moral hazard, a winner's curse that has societal detriment. And I'll double back and say, I actually agree with most of your conclusions, if not all of them. So it's interesting. We just arrived there in a very different way. There are issues with private equity, but in terms of incentives, most of the incentives that you're outlining, I don't actually think predominantly exist in the industry. I think they exist in a philosophy of short-term investing, which, by the way, is also associated with a lot of hedge funds that do private equity plus. No one's more short-term than a hedge fund investor. Private equity is actually very long-term because they don't actually have to mark their portfolio, strictly speaking. A lot of it is informed valuations. Right now is a perfect example. A lot of these portfolios are actually performing worse than a lot of what LPs are being told because the market is weak. There's very little demand for private equity assets right now. Transactions are off 60 to 80% from their peak 2022. And yet there's no panic. The level of bankruptcy is relatively low, as you know, and these sponsors are able to bide their time. And biding their time is very much an incentive built into private equity investing, built into all private equity investing, not just PE, LP, GP, but all private equity comes with this ability to bide your time. The panic of public sector mania doesn't really happen in this world. And so the incentive is actually more long-term than what you often see in other places. And with that time comes the ability to invest and invest wisely. The actual incentive of private equity is to stay in business. That's the primary incentive, to see out your fund and actually receive the dividends through carried interest. It's very back-end weighted. Most private equity professionals, I deal with them, feel grossly underpaid for 99% of the fund's duration. And if they're lucky, grossly overpaid for that day where they get to collect on the carried interest. That's the nature of it. And so their primary incentive every day when they go to work is, let's make sure this fund does well. That can lead to perverse outcomes like we borrowed too much, we debt recapped, we destroyed the company, and the company was taken away. Most bankruptcies of companies that involve private equity losing its equity value completely and seeing ownership of that business transfer to the levered entity, the creditor, right? Which is the bank. That's not good for business, right? You can mitigate that by taking money out of the business beforehand, but usually the amount of money taken out beforehand doesn't equal to the amount of equity that went in up till that point, or the potential upside of staying heavily equity invested in something and seeing it exit very well. That's the primary game of private equity. The primary game is not to debt recap. It doesn't generate great return. Debt recaps are not that good. They are within 2-3 years, so it's time adjusted, so there's some value to it. But you're not going to debt recap at 18 times EBITDA, right? You're going to exit a business at 18 times. You want a big win. You want a newspaper public relations article that says, look at this $1 billion revenue business. When I bought it, it was doing $100 million revenue. Look at this national company. When I bought it, it was tiny. That's the game they're in. And if they fail to do that most of the time within a portfolio, one fund, just one fund, they don't get to the next fund. There are exceptions to that. Apollo, Blackstone, they have multiple funds. They manage literally hundreds of billions of dollars. That's a different business. 99% of private equity is moving sequentially. 99% of private equity is moving sequentially from one fund to the next. And if the fund they're in today has bankruptcies, they go out of business and they lose their jobs. So that's my null hypothesis argument to the argument that you've presented regarding incentives. Doesn't mean it doesn't exist. It does exist. Vulture investing exists and stupid deals exist. Frothy markets where prices are too high and debt is too high definitely exists. And we can talk about that incentive, the incentive of needing to win a deal and what that does for risk. But I think you're wrong about private equity primary incentives. I don't think the management fee 2% is what keeps them in business. It is the 20%, the IRR, the ability to convince LPs to invest in them that keeps them in business.
Well, I think you've raised a lot of interesting points, and I think maybe we can start from the beginning, which is, sort of the nature of the people in private equity, which is, one of the things that I've really been adamant about doing is not criticizing the people in private equity, because like you, I've talked with various folks in the industry. They've been nothing but friendly to me. It seems like they take their kids to soccer practice, and I think very few, if any of them, sort of wake up in the morning trying to figure out how they can destroy a profitable business. So I don't think that the challenges that we have are because of the nature of the people in private equity any more than I think the problem that we had with subprime lenders in the 2000s was the nature of people in that industry, or the people in the savings and loan industry in the 1980s, the people there, or the conglomerates in the 1960s. I don't think it's a matter of personality or a sort of character that drives some of these misaligned incentives. But, we've mentioned obviously the fee issue, but the really interesting issue for me as a lawyer is insulation from liability, which is private equity firms are generally not the majority owner of the companies that they buy. As you know, they might have a 5% stake in the portfolio company or whatever it happens to be. It's the limited partners that have the lion's share of the equity in the business. But again, as you know, you have a sophisticated listenership, probably a lot of your listeners know, the private equity relationship is governed by a limited partnership agreement that will give the private equity firm, in essence, the driver's seat of the relationship with the portfolio company, often allowing them to choose the board members, or the officers of the company. And so we have this sort of interesting mismatch that American law hasn't quite caught up with yet, simply because I think a lot of judges and lawyers really are not familiar with the structure of these deals, where the private equity firm is able to exercise a great deal of operational control over the business. But if something goes wrong in that business, because we have the corporate veil piercing doctrine, which is entirely appropriate, it's very hard to hold the private equity firm specifically responsible for wrongdoing. And so you have just an agency, a principal agent problem where the person making the decision often is not the one that's responsible for the consequences of that decision. So to go back to your sort of original point at the beginning, I don't think that this is a challenge of people having the wrong character or, waking up with bad intentions in the morning. But I do think that people are responding to legal incentives. And so what I think that means is that private equity ownership just, and we can do this through anecdotes, but I think it's better to sort of talk about this through legal incentives, are often incentivized to take risky business plans that wouldn't necessarily be the case with a company that was not owned in this way or a public company. Now, I think one area where we really agree is sort of the long-term or short-term perspective of public companies, which kind of live or die by the quarter. And that's sort of the promise of the private markets, that they're going to have a longer-term perspective here. But I think that the challenge that we've got is if something goes wrong at IBM or Dow Chemical or something like that, somebody, gets a defective product or gets injured or, develops cancer, you can sue IBM. You can sue Dow Chemical. The exact same behavior by a private equity owned portfolio company, it's going to be very hard to hold the private equity firm responsible for those consequences. And so I think that's the basic challenge that we're facing right now in the industry.
You would know more about that than me. I think it's a wonderful topic. The strict legality of, forget minority control. I don't actually know if majority of private equity is minority or majority. I think it's a fair estimation that to argue either side. There's hundreds of minority equity, private equity investors. They do hundreds of deals. I don't know. There's a demand out there for a 20% ownership, a liquidity event, growth capital. It starts to feel a little bit more VC, but it's not because the assets are mature. Different names. Again, we're talking about private equity being different things. I feel very empathetic to that entire universe because unless you really find exceptions in governance, operating agreements, and language surrounding governance, majority of them do not have control over those businesses. As per their namesake, they're minority, they get outvoted, and they get informed what the deal is with certain vetoes provisions. You will not borrow this much unless I approve it. But those veto provisions, as you know, Brendan, they're limited. It's not a long list. Those companies are majority owned and majority controlled. The universe of majority controlled private equity assets, which I actually would suspect is the larger universe, raises a much more interesting question in terms of liability. If you own 51% of the business and you're in control, you're in the driver's seat, you have a CEO, you have agents, but they report to you, your board, it's your business. And if the business makes bad decisions, it was you ultimately responsible for those decisions. And so I agree with you. I agree with a lot of what you say. Private equity does this dance of it was us, but it wasn't us. It was us if everything went well. We want to take the credit. But it wasn't us if everything went badly. We were just private equity on the side, observing. I think that area needs a lot more investigation. And investigation from a research standpoint of the litigation. How many times did a private equity sponsor get sued and lose a lawsuit over a company that was engaged in malfeasance, where it was the majority owner? I would like to think, but I just haven't done the research, that our legal system is such that if you're running a board, there are board minutes, and you're saying the wrong things, recommending the wrong things, being negligent, being bad, business is risky, then we should explore that. But here's my counter argument. Here's where I want to be difficult with you today, but in a very loving way, because I love the topic and I love your conclusions and I love your entire interest in it. The primary risk in private equity is not litigation exposure, and it's not incentives. We're on an investigation, Yumi, like a murder hunt, and we're sniffing around for where the risk really resides, like truffles in the ground. It's not here. The primary incentive of private equity is to create value and they are incredibly conservative. They show up every day, once a week, weekly phone calls with the CEO, and they say, where are you taking risk right now? Stop doing that. I know those calls. I'm on those calls. They find CEOs who take less risk. They want boards that are more disciplined. They want risk officers. They are so risk averse in every way but one. There is one truffle that represents, I'll use an estimation, 99% of the risk that you're looking for. And it's not, hey, I'm not going to be sued, so therefore I can take this risk. The risk resides in two sides of the same coin, and the coin is called transactions. Every private equity asset comes with the same universal law. It involved a change of ownership. It involved a transaction. It involved a liquidity event where ownership moved from party A to party B. Every transaction in America and across the world represents acute risk to every company, with private equity or without. As soon as you change ownership, balance sheet changes, governance changes, culture changes, business plans change, language, accountability, communication, all these things change. And I can tell you, our understanding of how much risk comes with those transactions is not good. Why? No one talks about investment bankers. Nobody. There's no book written investment bankers, plunderers of America. And yet, when you look at investment banking, what's their incentive, Brendan? What's their incentive? I'm asking you genuinely. What's their incentive?
I'd assume to do the deal.
654% commission. What's a commission? It's a function of the size of the deal. All of them, from Goldman Sachs to the smallest boutique, they all price exactly the same way. Do they do well when the deal is half the price, or do they do well when the deal is twice the price? Do they take a cut if the deal is 50% levered as opposed to 10% levered or 80% levered? Makes no difference to them. What drives them singularly is the size of the deal, the auction, the bid. And that is the world that private equity has to live with. Otherwise, they don't get to see the asset. So just to be in the business of being in private equity, you have to absorb all that brokerage risk. And that is a ton of risk. When you ask a business to justify a 15 times purchase multiple, 7.5 of which is leverage, it's already taken on so much risk. It's taken its margin of safety from this and squeezed it down to this. All of a sudden, you have a bad quarter, you're in default. You're firing people. You're rationalizing. You're looking for, to put out fires. It's panic, right? And that's what private equity brings when it has to buy a business. So it creates risk because of winner's curse. If I had my wish, if I wanted to take risk out of America, and we want to, both of us are looking for the same goal. And by the way, we're going to get to your other conclusions because I do agree with all of them. They all have tremendous value. I would start there, transactions. The other side of that coin is what happens once they own. They want to transact again. They want to keep transacting. Why? They are very focused on creating value to a detriment. I think it's a fair criticism of private equity to say 5 years average hold period is not enough. It's too short. And so when you look at an average private business and you try to squeeze in 15% after tax, a 30% pre-tax, annualized rate of return, that's a lot of return on a compounded basis, right? Compounded. It's not just 30% year one, it's 30% on top of the 30% that you generated year one, right? That's a lot of pressure to put on a CEO and their team, right? And so how do they deal with that? Well, we're here to help you buy stuff. Don't worry about the organic strategies. Your digital media campaign is not really working that well. That new office that you just expanded to in the Far East, it's not happening. We're just going to go buy stuff and we'll create growth that way. And that's their plan B, in many cases, plan A, always. And so you see 9 out of 10 private equity-backed companies are busy what they call tucking in. Those deals bring their same version of that banker risk. Overpriced, overlevered. Liquidity event, someone's just gotten wealthy, they've lost their incentive to work, there's a new owner, right? 20 years of history, of a certain way of doing things, knowing the customer, knowing your staff, all of that's disrupted. So the volume of M&A that private equity stimulates, I think, is the truffle you're looking for. It's very real.
Yeah, no, and I think that's a really interesting point. I think it's an interesting idea about how there's an entire ecosystem around this that incentivizes inflated valuations. You mentioned the investment bankers. You could also, in some cases, point.
My brother runs one of the largest banks in the world. He's the global head of Jefferies. So this is me fighting my own. I hope he doesn't listen to this.
I don't mean to pit brother against brother, but I think you could also point to the executives of the portfolio companies when they're selling. If they're compensated in equity, they've got an incentive to exit with the highest valuation possible. And so, when you're talking about small roll-ups of veterinary clinics or OBGYN practices and things like that, the sale can be enormously successful for the retiring veterinary doctor or, physician, but can put an awful lot of pressure on the employees that remain. So I think we're in agreement that there is something of an ecosystem that can incentivize inflated evaluations. I did want to go 2 steps back on sort of the research around legal insulation from liability and sort of generally what I've seen there. Because I agree with you that, if the system's working, the decision makers should be held responsible for the consequences of their actions. That is it's not just a sort of fundamental principle of law, it's a fundamental principle of ethics. The problem is, as you can imagine, the law doesn't always match up with how we think it should be. In fact, I was talking with a private equity executive, a year or 2 ago on the record, actually, and he made a point. He's like, yeah, absolutely. We think about the extent to which the firm is going to be liable for the portfolio company's actions. And we look to geographies where we think that's going to be less of an issue. And I think one of the areas where there actually has been pretty good research has been in the nursing home industry. So I believe this was a study from about 2007. It's quite old now, saying that the average number of shell companies separating the nursing home assets from the ultimate parent entity, I believe at that point was about 6 companies. Presumably in the 15 years since, it's gotten a lot more complicated than that. And there's actually really interesting presentations by lawyers in the nursing home industry talking about how you can insulate corporate or financial owners from the actions of the nursing homes themselves by, for instance, distributing assets between the nursing home operating company, its real estate company, its staffing company, and so forth. The idea being that if you can make things complicated enough, even if the law ultimately was going to get to the right place, a plaintiff side lawyer representing a single patient is going to have an awful hard time getting to that. And that problem is compounded by the fact that, and again, I'm focused on nursing homes, but we can extrapolate more generally, as so much of our civil litigation system is getting replaced by forced arbitration. And so what that means is you have a private justice system where you have limited discovery, no opportunity for appeal, and the arbitrator is often selected in part and occasionally paid for by the entity that's being sued. All that's a long roundabout way of saying that I think there are a lot of instances where in American law, people are able to make decisions, but because of, unfortunately, us lawyers, we've been very good at insulating those folks from the consequences of those decisions.
I'll rephrase what you said, okay, in a way where we are in full agreement. The framing is everything here. So private equity doesn't like nursing homes, but we have a misunderstanding on the heading, private equity, the terminology. I speak for thousands of funds, the 800 that I'm aware of and the others. Not that many though. Call it 2,000, 3,000 use Pitchbook download active in the US. I know it's a big number. I don't know, it's 1.5 trillion today, 2 trillion. Last I checked a while ago when I was a banker, it was 1.2 trillion. It's a big number. It's a very small number of parties that actually represent that amount of assets under management dedicated to private equity investing. They don't like nursing homes and they don't like hospitals, which is what makes something like the MedPAC report that I know Congress waited 4 years for hilarious, because those were the only case studies. It doesn't mean that there aren't examples of it. Of course there are. There are some nursing home private equity investments. There are some hospital private equity investments, but you look at the portfolios, add up all the companies that they've invested in, 5%, less than 5% combined, hospitals and nursing homes in healthcare. Why do we keep talking about nursing homes and hospitals? What about the other 95%? Well, if you look at the other 95%, ophthalmology groups, dermatology groups, orthopedic groups, dental groups. Dental happens to be the most popular asset for healthcare and private equity. Not talking about venture capital. I said earlier, venture capital has a better name than private equity because venture capital can blow up 9 out of 10 investments. Dead, bankrupt, disrupted, fired, empty office, have one Google, and they are famous for making the world a better place. We don't have that in private equity. Private equity isn't making the next Google. There is no mythological, euphoric discovery of some new drug in private equity. They are a boring asset class that simply wants to grow things at a 15% tax-adjusted annual basis, which is 3% higher, maybe 5% on a weighted basis versus the S&P. Boring as you can imagine, which, by the way, why they tend to be quite conservative. Venture capital is all about risk. Nursing homes are very risky. Hospitals are very risky from an operator's perspective, which is why if you're going to get involved in nursing homes, you're a special kind of private equity group that knows how to shield against opco risk by creating real estate co and focusing on that. Shield against opco risk by creating all these liability protections, complexity, intentional complexity. It's a different language. When you focus on the 95% of healthcare assets that are just scaling relatively straightforward businesses, by the way, they don't do that much life sciences either because it's too risky. They don't do a lot of new drug development. They don't do a lot of new med tech. If you look at the average private equity portfolio measured across hundreds of funds, you'll find very little life sciences. You'll find business services, pharma services, right? You'll find brick and mortar. Maybe some of those businesses will have increasing exposure to technology through virtual care, a little bit of AI, but for the most part, rinse and repeat businesses, millions of patients, which, by the way, should require a lot of regulatory oversight and understanding from us because this is hundreds of millions of US patients flowing through private equity-owned healthcare assets in this country. Of course, transparency, of course, disclosure, of course, research. But framing the conversation is important before you even engage in the policies that you need. The examples that you offer of cracks in the system where all kinds of, I don't want to call them shenanigans, but let's call them shenanigans, can take place, are very real. But it's important to frame it as the minority. It's the lesser groups that are doing that. Typically, the very largest, like Apollo, right? Or like Ares. These are groups that manage tens of billions of dollars, if not hundreds of billions of dollars of private debt that has to justify returns. They are the ones that are not only investing their equity, they're predominantly investing their debt on top of their equity. So it's a different game. And yeah, have at it. Make life difficult for them. But when you label it all private equity, and those regulations start to impede the ability of most funds who are simply interested in a 15% annual return that's entirely funded by the only thing they have, which is equity. They don't have debt. They don't lend money. The 98% of private equity funds do not lend money. They only invest equity. They don't have a mandate to lend money. They go to banks for that, right? Then it in some ways might risk and impede this group's ability to do what they mostly do, which is actually make America a much better place. Call me crazy for saying, I say a lot of crazy things. I think US healthcare is the best in the world. That's how crazy I am. But I think private equity has its acute risk. As I said before, the truffle is in the typically overpriced assets. Even when they're trading at 7 times, they should be trading at 6 times because these auctions are so competitive and they create moral hazard. They really do. No one likes to spend 6 months chasing an asset, investing millions of dollars in due diligence only to get nothing. It's completely binary. And most of the time you're getting nothing. Most private equity professionals are spending days losing, trying to win it on auction and not winning it. It's very depressing. So when they can win, when the banker puts in front of them, oh, just one more turn, from 13 to 14 times and the asset's yours, they typically, not often, they nearly always say sure.
Yeah. So we do have that area of
exception versus the rule.
Yeah. We do have the area of agreement on the amount of leverage. I would push back in thinking that this is the exception rather than the rule. in terms of the legal incentives, I think you're right that nursing homes are, really a niche investment for just only
horrible.
some.
They're
Yeah,
horrible.
but
They generate no return. You have absolute full 24-hour, 7-day-a-week risk. No one goes home, right? 3 o'clock in the morning on a Sunday, that's your responsibility. Christmas Eve, that's your responsibility. The pricing, the reimbursement level is horrific. And so the only play is the asset play and the real estate play, which is good because you have a captive audience, you have long-term leases, right? So you can work with that. Most private equity doesn't do real estate. Real estate
yeah,
is real estate.
yeah, no, and that's all interesting. I think, the challenge that we've got is you see some of the same legal insulation happen in other parts of the healthcare industry and in other parts of the economy generally. One of the stories that I was looking at was the acquisition of Apria Healthcare, which made non-invasive ventilators. Well, during COVID and after, there was, they had very strong pressure on them to make sales, and ultimately, as alleged, marked sales that never actually occurred to the government. Now, the Department of Justice sued Apria under the False Claims Act for, trying to bilk the government, and eventually got I believe about a $40 million settlement. But that settlement didn't extend to the private equity owner of Apria. And in fact, the private equity owner, I believe this was in the public reporting of the New York Times, was actually able to make more than the $40 million back on a dividend recapitalization. So I think that's one example. And again, I understand that we've got a battle of the anecdotes, but I think that's one example to suggest that the challenge that we have in legal insulation is more general than just nursing homes. It's a general issue that we've got. And that was under the False Claims Act. That wasn't under common law veil piercing, but it's one area where, again, you see insulation from liability. And I'll just say, I think the strategy of trying to create fairly complicated ownership structures is, again, something that extends beyond nursing home and into other industries. I was talking with an acquaintance that was looking at private equity acquisitions of insurance companies, life insurance companies. And he told me, and he said the organization structure for the acquisition, just the outline of it, not the full detail, was something along the lines of 32 pages. And
now we're bringing another constituent, which is overpriced lawyers.
Yes, we all might be
overpriced. A very
overpriced.
large legal fee.
Yeah. But I think we agree on the over leverage part. I think where we have some area of disagreement is whether the misaligned legal incentives is the exception or the majority of cases.
Yes. We disagree on exception versus the rule. I think you're going to find examples of everything that you're saying. There are some funds that rather than spend a day thinking about improving the management team and creating better customer satisfaction, are going to spend a day thinking about manipulating a tax code, right? It's the John Malone approach to media and cable communications. Like, how do we create a tax-free carve-out? Why don't you think about creating the next Facebook? So in the world we live in, there's enough private equity examples that you're going to find everything. I don't think it's something that the average fund wakes up in the morning and focuses on. They've just got too much on their plate. You have to appreciate most of them are grossly understaffed, right? They're overpaid when everything goes well. When they're in normal day-to-day, there's no money. The money's going out the door to invest in assets. It's like football teams. The money's going to the players. All they have is a fax machine, right? So these businesses, they're not, until they get to Apollo and Blackstone level, a typical private equity fund is $200 million to $1 billion average fund size, not $5 to $50 billion. At $200 million average fund size, you do the management fee calculation, 1% to 2%. That's a very small revenue business to pay for some very expensive people that are coming out of large banks and used to making millions of dollars per year, right? So what do? They tend to not hire a lot of people. Look at the average fund team. It's all public. Every one of them has their team on their website. And by the way, what they own on their website is actually quite helpful. A lot more transparent than a hedge fund. You'll never know anything about a hedge fund. They give you one page. These are not large teams, right? So they just don't have the time to spend on every last manipulation when they're consumed by board meeting after board meeting, deal after deal after deal. Granted, will you find examples of very large law firms that concoct all kinds of crazy schemes that some sponsors say yes to and fall in love with? Sure. I would tell you the average management team doesn't have the time either to do that and is prioritized on execution. And most companies, if you go around, you meet management teams, CEOs, they have an allergic reaction to things that are not core. things that they're not really focused on, delivering on their promises, right? It's very hard to do that and grow a business. So it doesn't mean you won't find your examples, but to say that this is the norm, I think is exaggerating it. I'll finish up by saying this. It's an amazing topic. Of your list of recommendations, and I'll just quickly race through the headings of them. Hold private equity firms liable, responsible, where they're responsible. There's nothing fundamentally wrong with that. I mean, principally, it sounds right. Where there are good people in private equity, they will agree to be responsible for what they're responsible to. Reform bankruptcy and debt practice, I don't like fraudulent conveyance. And if you find it, there's an issue. Regulating fees and compensation. I actually think we didn't touch on carried interest being treated as non-ordinary income, as capital gains. And I think that's a very interesting topic because I'd probably lean towards treat it as income and taxable as income. So that's interesting. We probably agree on that. Labor and worker protection, I would agree with that. Closing regulatory loopholes. Again, I don't think it represents the industry. It represents a portion of the industry, but I would agree with that portion being treated appropriately. We don't like shenanigans. Like every constituent class in America, every single one of them doesn't want shenanigans to dilute the brand, right? I would like Envision to be the world's greatest ER staffing business. Everyone grows up in a world where it only takes an anecdote or two. One or two doctors in Texas saying, well, this was the experience that I had, for bad things to happen, people to rush to conclusions, bad regulations to follow, and things to fall apart, while most are busy doing good things. So we don't want the shenanigans. Good. Let's regulate better, but let's do it based on your sixth recommendation, which I think is the best of all. And if there's one change I'd make to the book other than the heading, because I think the heading is misleading. I think it grabs readers, but I think it doesn't help. It hurts. It's not fair. There's one recommendation that I would change, and I think all the others are good. I would move the order. So where you end, I think, and this is assuming I got the order right, with increasing transparency and public awareness, that is the first step. That's the first step, because there is so little good information out there. We as a populace just don't do enough scientific studies. What is actually going on before we even use the term private equity?
Yeah. No. Well, I certainly agree. I think increasing transparency here would be enormously helpful.
And it's a huge space.
Yeah.
Huge.
Yeah, absolutely.
Brendan, thank you for your time.
Hey, thank you.
Really appreciate it.
Thank you for joining us on Analyzing Healthcare. Stay informed and stay inspired. Don't forget to subscribe and visit scale-community.com to become a Scale Community member. Until next time, keep exploring the ideas that shape our healthcare systems.